Hi, I've got Jay Hatfield with me today. He's the CIO of AMZA, a publicly traded MLP fund. And we're just going to sort of talk about the midstream space some and sort of talk about some of the developments and what some directions are for my research as I work on a feature coming out in the future. And thank you, Jay, for agreeing to spend some time helping figure this out for me. I appreciate it very much.
Thanks, Jennifer, for having me on.
So my first question is, first of all, just because I've never asked you this question, is why have you chosen the MLP space for your fund?
Mhm. Well, MLPs are really the only way to get high income that's fully tax deferred or normally tax deferred. And the reason is because they're structured as partnerships, most are, and they do make investments, and those investments qualify for accelerated depreciation. So they then distribute that accelerated distribution or depreciation, sorry, into something called a K1, and then that de facto defers your tax.
Mm-hmm.
So you can buy municipal bonds, but they probably yield 3 or 4%, and that's at least partially tax free. But this is fully deferred,
Mm-hmm.
and right now, at least, there's pretty good capital appreciation opportunity because the companies now have the characteristics that all good dividend stocks do, in that they have good coverage of their dividend, they're retaining earnings, they're investing them, and they're growing earnings. A lot of investors don't appreciate that most earnings growth comes from reinvesting earnings, not from margin expansion. So it's an attractive asset class now. It had been challenged, just like all energy stocks. Now it's attractive, good total return opportunity, but importantly, very high yields at close to 9, tax deferred.
Okay. Yeah, so the investment case is very strong for them. And in talking about a strong investment case, do you have like a horizon, like just given the fundamentals right now and the dynamics in the market? I mean, would you say that this is real solid for 3 to 5 or 5 to 10? I mean, do you have any color on that?
Well, it used to be pretty controversial because we really think that it's more 30 to 50 years. And so 2 years ago, before the European energy transition essentially blew up with the help of the Russians, but it already had imploded
Right.
prior to that. People kind of forget and
No, yeah, we've talked about it. Yeah.
So people started to realize, and it's now even in the New York Times, etc., that the utopian vision of having all electric vehicles with all powered by solar and wind is probably never going to happen, but is going to at least, even on the best of all worlds, take 50 to 100 years. And I have the perspective in that I've been working on renewables for 35 years, and there's still less than 5% of total US energy use. They're very hard to cite. And once you do the first 5, you'd say, oh, it'll be easier to do the next. Not really, because you used up the best sites.
Yeah.
You used up all the best wind sites, and a lot of the good solar is more broad-based. So we don't subscribe to the notion, even though a lot of politicians do, that we're only going to use electric vehicles by XYZ time.
Right.
It's not practical. It's not likely to happen. So there's going to be a demand for hydrocarbons for at least 30 years, probably 50, maybe 100.
Yeah. Wow, that's a big time horizon. We're going to be dead by then.
Unfortunately.
So the other question I have is sort of now on price expectations. We saw a little movement finally, because of the inflation print today, and have you changed your range at all? I know it was like 70 to 90 or 75 to 95. I mean,
yeah, we're still sticking with 75 to 95, which might seem a little odd. And that we don't really believe in, we don't believe in both sides of the equation. So we don't believe in changing our range every time the market goes up and down. But
Right.
nor do we believe, like some strategists this year are still calling for a $3,000 S&P. So we do think you should mark your, your judgments to market for sure. But so we've been pretty reasonable about our range, so we weren't really that bullish. And what we view the near term, and this is odd, and a lot of people won't appreciate this, but we think a lot of the near term weakness in oil is as much to do with the tech boom as it is with fundamentals. And nobody really appreciates this, but energy, including the commodity, has a negative beta to the NASDAQ. And the way that shows up is people are like, oh my God, if Nvidia is going to 1,000, why do I own oil? Why do I own oil futures? Why do I own ExxonMobil?
Yeah.
There's this rotation of impact that seems like it really shouldn't be true, and can't be true, but yet is true.
Right.
And so,
Yeah. Yeah. The inverse
so we think
relationship.
that as we get into the summer and China continues to recover, and we get to the peak of the travel season, it might get hot. It's good for at least natural gas. That we'll go more into our range, and it's so we're using our range. It's not a perfect range, but to just indicate oil's much more of a buy below 75 WTI than it is a sell, and we pretty much stuck with that. And it's almost always bounced pretty hard off this, sub 70 area, just like it is today. So we don't see any big change in the fundamentals that would require us to change our range.
Hopping back to midstream, obviously there's, discussion about the constraints in the Marcellus and how there's just a lack of pipeline takeaway capacity and in different directions. Do you have a little color on that? And are there any other constraints in midstream that you see, just given the supply and demand dynamics?
Well, it's definitely a good topic to bring up because Mountain Valley Pipeline did get approved, in the debt ceiling deal, and so that's a huge amount of takeaway capacity that's pretty close to being complete. So that is positive for prices in the Appalachia or Marcellus region. And it's also positive for the environment, which a lot of people don't seem to care about, or implicitly don't care about, because that's going to displace coal at the margin.
Right.
But the reason, though, that even though that's going to be positive for, the prices right there in the Marcellus Shale, the reason that natural gas is likely to continue to be a great fuel in the U.S. is that drilling for natural gas is really not in the Marcellus, but in most of the United States is a waste product of drilling for oil.
Right.
To the extent that OPEC and some global ESG movements are keeping oil prices high, that's actually strangely going to keep natural gas in the U.S. low. Because we have this, if you look at an ancient map of, or prehistoric map of the United States, there's a huge inland sea in the mid-continent that is just full of hydrocarbons, and they're almost always mixed between natural gas and oil. So not in the Marcellus, but in mid-continent, you're going to get continued drilling. Gas is going to be cheap. It's going to be exported. So that dynamic is quite stable and should keep our prices really quite low because the conversion, as you know, is 6 to 1. So if natural gas is at $2.50, that's the equivalent of oil being at $15 a barrel. So it's a big advantage to the U.S. economy as well, which nobody focuses on.
Right. Wow. Yeah. Yeah. And it sort of throws out the window the argument of, that sort of superficial argument that, if we export all this natural gas via LNG, it's going to make the prices go up. But kind of what you're saying is it's just going to begat, ample supply just because of our resources.
Yeah, it is virtually unlimited, which some environmentalists don't like, but just the geology of the United States was ideal for hydrocarbons because we had this inland sea, and it was a very biologically rich inland sea. And so it just produced a lot of material that converted into hydrocarbons.
Yeah. Oh, wow. I got a geology lesson today. Thank you, Jay.
It's interesting to go review that map. I hadn't done it in a while.
I am going to look at that map.
And it was literally two continents. So
Well,
that's
and I actually, when I was researching the Permian a lot, I used to focus more on the geological aspects, because that was all everybody was discussing at the time, was the layers and this and and all of it. And I was looking at these maps and with all the shale booms, so that's kind of good, because then I'll go back to my origins on this.
yes.
No pun intended.
Obscure facts.
So are there any other headwinds in general, with natural gas midstream, that come to mind this year or next year? Anything that
Well, that this is a strange comment, but the midstream now is in great position, notwithstanding the approval of the Mountain Valley Pipeline. So that's an exception that proves the role, because keep in mind that was 90% built.
okay, yeah.
So it's actually kind of amusing. A senator from Virginia said, "Oh my God, it's going to be terrible. All these people's land is going to have a pipeline built across it." Well, it had already been built, so it made no sense. But
Yeah.
but notwithstanding that pipeline, it's actually great for the existing industry to not have the ability to be competed with by new pipelines being built. So it gives them a monopoly, de facto monopoly. So the real risk is that you have, a new administration, which obviously would be most likely Republican, comes in and say, okay, let's completely deregulate building pipelines, and then you have massive competition, it gets overbuilt, and then returns drop. So that strangely would be the biggest risk.
Mm-hmm.
Not that new pipelines don't get built, not that magically we supplant all hydrocarbons in the world with wind power, but rather that there's just too much deregulation and too much competition and overbuilding of pipelines.
Yeah. Well, don't you think that the midstream firms would hopefully do what the producers do, which is, shareholders demand a return, therefore they have to, have restraint. I mean, surely that lesson's been learned from everyone getting burned,
Right. So it's more of a fear than actual reality, but
Yeah.
we've seen it in the past.
Yeah. True.
And even kind of post boom, where you would have thought people would be more conservative. So I'm not really, it doesn't keep me up late at night, but if I were just to say, it's really a backhand way of saying that fundamentals are very, very strong. And they're not really that dependent on short-term commodity prices or China demand.
Yeah.
I mean, they trade like it is, but it's a lot of it is just flows. Like energy is out of favor because right now, I mean, I believe this as well. Like Nvidia is just a more exciting stock than Chevron.
Yeah. Yeah.
I believe AI is the biggest technology development of the century, and there's strong evidence that demonstrates that if you look at Nvidia's call and start to assess this tremendous demand. So I understand why you'd rather own Nvidia than than Chevron. But if you like 9% tax deferred yields, it's still extremely attractive.
Yeah. Yeah.
Not everybody should be all in tech stocks. It's very risky, and if you're about to retire,
Yeah.
it's a disaster.
Yeah. Yeah. You definitely have the time horizon factor. Yeah. I was just funny enough. I was just working on all that AI and semiconductors, just, like before we hopped on the call, I was sort of finishing out some of my Fed learnings from the experts I was there with. But so my other question was, I mean, with US midstream and the Russia situation, is there any, I mean, the opportunity is obviously that we're going to get to export more LNG. What do you see as some of the status on some of the LNG that is going to be, put in service or will be put in service?
Well, I mean, certainly the sentiment is not good because, we've had a collapse really, which is good for Europe, of natural gas prices in Europe. but there is still an arbitrage, and we do expect during the summer that arbitrage will open up, and or not this summer, next winter, because weather does matter
Right.
and volatility matters, and nobody wants natural gas when it's cool, when it's in the shoulder months,
Yeah.
and everybody thinks that all their problems are over. And then
Right.
it's hot, and then the wind doesn't blow, and then all of a sudden it goes up. I mean, it's the most volatile of all commodities, probably
Right.
the most volatile of all asset classes,
Right.
in the short run, at least.
Mhm.
Maybe argue Bitcoin's more volatile, but in the short run. So we think that arbitrage will open back up. I mean, it already exists, but it's not as lucrative as it used to be,
Right.
because it's just that there is no mid-continent in Europe. Even if there were, I mean, there is the North Sea, but they don't want to drill it.
Mhm.
They're much more aggressive about that than we are. And so that's an ongoing business. It's going to continue to grow. It's great for the environment, should be supported by all environmentalists. Almost certainly won't be, but
Yeah.
should be.
Yeah, and then also with the United States, I mean, obviously we have all this infrastructure build out, in oil and gas. I mean, that's a huge, competitive advantage that's kind of probably under-recognized, all the assets we have built and keep building because of the shale booms. The other question I have is there some leading firms of note to you that are sort of, doing things that are, that you like in your fund?
I don't think there's tremendous innovation going on right now. I think that I'm positive that all the firms really adopted a much more kind of dividend aristocrat approach to their business. So, retaining earnings, low leverage, not trying to grow too fast. But that's thankfully been copied by almost everyone.
Mhm.
And so I guess we see certain companies that are great operators. And also we favor the ones that are most diversified,
Mhm.
national. So like actually OKE is merging with MMP, or One Oak is merging with Magellan. And we like that merger. There's some bad tax aspects, but because you create a diversified entity. Because the flip side of what I said is, like almost all the businesses are likely to continue, but it's not impossible that maybe in certain regions gasoline comes under pressure and needs to be exported or something. So it's better to have diversified operations. So we favor the large, highly diversified companies with natural gas, oil, fine products, even gathering and processing, LNG export. So I just think it's meant to be an income vehicle. So you don't need to go after the most risky company that has the most upside.
Right. Yeah, that makes sense. Well, that's all I have. I mean, is there anything else that comes to mind that as I'm focusing on this space that I should be looking at or exploring? That we
No, I think that the recent price action's a little bit surprising, but in light of China's just kind of proving that capitalism works. They kind of suspended capitalism for a while, and then oh my God, it's so shocking that we're not growing as fast.
Yeah.
So that dynamic's out there. I think it'll attenuate some. I do think that some of the recent weakness in oil is just due to financial flows, which is hard for people to understand, but is actually does happen.
Right.
And those are kind of the two key dynamics. I think people are a little bit too negative about the commodity right now.
Right.
That's partly because they're excited about other sectors that are doing better.
Right. Well, thank you for your time, Jay. Appreciate the insights.
Anytime, I enjoyed it.